Blockchain is a revolutionary technology that acts as a decentralized digital ledger. Imagine a network where every transaction is recorded and encrypted, creating a secure and tamper-proof system. Each transaction gets locked into a block, which is then chained to the next, forming an unbreakable link. There's no central authority controlling it, just a network of nodes working together through consensus. This openness not only enhances security, but also fosters trust, making it the backbone of cryptocurrencies and a game-changer for industries worldwide. It's like having a digital vault that everyone can see but no one can alter. Crypto mining is the process of verifying encrypted transactions through complex cryptographic puzzles. Miners, often working from their homes or specialized facilities, solve these puzzles to add new blocks to the blockchain. In return, they earn cryptocurrency as a reward. What began as a hobby in garages has exploded into a billion-dollar global industry, attracting tech enthusiasts and investors alike. It's fascinating how this digital gold rush has transformed the way we think about money and technology. Mining crypto isn't a quick win. It's all about strategy and patience. The time it takes to earn crypto can vary wildly based on the type of coin, the mining difficulty, and your equipment's power or hash rate. For instance, Bitcoin averages a block every 10 minutes, but don't expect instant rewards. With high difficulty and many miners, it could take years to snag a single Bitcoin if you're going solo. That's why many opt for mining pools. By teaming up, you can earn smaller rewards more frequently, instead of waiting ages for a big payout. So if you want quicker results, joining a pool is your best bet, even if the rewards are shared. It's all about maximizing your chances.
Crypto mining requires some serious gear. For Bitcoin, ASIC miners like the Antminer S19 Pro or WhatsMiner M30S++ are the go-to, costing between $1,800 and $6,000. The more powerful the machine, the pricier it gets. If you're into altcoins like Ethereum Classic, you'll want a GPU rig, which can set you back anywhere from $600 to over $9,000, depending on the graphics cards you choose. On the software side, options like Hive OS and CG Miner are popular, with many being free. Don't forget about mining pools, which charge a small fee for better rewards. And when it comes to storing your earnings, you can opt for free wallets like Trust Wallet or invest in a hardware wallet for added security, costing between $1 million and $3 million. Just remember, prices fluctuate with the market, and electricity costs can eat into your profits. Crypto mining, especially Bitcoin, is a costly venture. Miners invest heavily in powerful ASICs or GPUs, and they need solid infrastructure. Think server racks, cooling systems, and fast internet. The biggest hurdle? Electricity. Mining rigs run 24/7, racking up bills that can soar into the billions annually in places like the US. That's why many miners hunt for cheap or renewable energy sources. But are these costs worth it? It all hinges on Bitcoin's price and the efficiency of the equipment. When prices are high, profits can be substantial. But if the market dips or energy costs spike, miners can face losses. Plus, every 4 years, Bitcoin's block reward halves, tightening the squeeze. The rewards come directly from the blockchain with no boss in sight, just a fully automated, decentralized system that sends new coins straight to the miner's wallet.
A crypto wallet is essential for managing your digital assets. Instead of holding coins, it stores cryptographic keys. your public key for receiving funds, and your private key for sending them. Without that private key, you can't prove ownership or make transactions. There are two main types: software wallets, which are convenient but vulnerable to hacking, and hardware wallets, which keep your keys offline and secure, like a USB drive. Never store all your assets on an exchange. They're easy targets for hackers. Always keep your private key and recovery phrase offline. Use two-factor authentication and stay updated. In the crypto world, you're your own bank, so take control and protect your assets wisely. Crypto transactions operate on a decentralized system known as blockchain, which sets it apart from traditional banking. Instead of a central authority, a network of computers, called nodes or miners, validates and records each transaction. It all starts when you enter your transaction details in a digital wallet and sign it with your private key, proving ownership. The transaction is then broadcast to the network, where nodes verify the funds, prevent double spending, and check the signature. If everything checks out, the transaction gets added to a block, mined using methods like proof of work or proof of stake. Once that block is on the blockchain, the transaction is permanent and secure. This system offers decentralization, cryptographic security, consensus mechanisms, and immutability, allowing for fast, safe, and cost-effective peer-to-peer transactions without intermediaries.
Proof of work and proof of stake are the two giants of blockchain verification. POW, like Bitcoin, relies on miners solving complex puzzles, consuming tons of energy in the process. It's secure but costly. On the flip side, POS, used by Ethereum and others, rewards validators based on the crypto they stake. It's more eco-friendly and efficient, but it risks centralizing wealth. Those with more coins have a better shot at validation. Both methods aim for security and decentralization, but they take very different paths to get there.
Nakamoto consensus revolutionizes how computers in a blockchain network agree on valid transactions, all without a central authority. Introduced by Satoshi Nakamoto in Bitcoin, it tackles the trust issues in distributed computing. The secret sauce: proof of work. Miners race to solve complex puzzles, and the first to succeed adds a new block to the ledger, earning coins and transaction fees. To keep things fair, the difficulty adjusts, so a new block appears roughly every 10 minutes. In this decentralized world, if two blockchain versions emerge, the network favors the longest chain, ensuring security and consistency. This pure proof-of-work model is the backbone of Bitcoin, Litecoin, Dogecoin, and more, proving that hard work and the longest chain rule create a secure and honest network.
Ethereum 1.0 relied on a proof-of-work system, where miners solved complex puzzles to validate transactions. This method was secure but energy-hungry, processing only 15 to 30 transactions per second, leading to congestion. Enter Ethereum 2.0 and the merge. Now, we've shifted to proof of stake, where validators lock up 32 ETH to secure the network. This change slashed energy consumption by an astonishing 99.95%, making Ethereum far more eco-friendly. With the Beacon chain managing validators and transactions, we're paving the way for a faster, more efficient blockchain. Plus, anyone can participate in staking pools, democratizing access. Ethereum is evolving into a sustainable powerhouse, ready for billions of users.
Proof of work, or POW, is notorious for its massive energy consumption. It's like a race where thousands of computers compete to solve complex puzzles, wasting energy as only one miner wins the reward. This process, often powered by fossil fuels, results in a carbon footprint comparable to that of a small country. In stark contrast, proof of stake, or POS, operates on a completely different principle. Here, validators simply stake their assets to secure the network, eliminating the need for energy-hungry machinery. After Ethereum switched to POS, its energy usage plummeted by an astonishing 99.95%. POS is not just efficient, it's a game changer for the environment, making blockchain technology sustainable and eco-friendly. The difference is clear. POW is all about heavy lifting, while POS is about smart staking. The Byzantine general's problem illustrates the struggle for consensus among untrustworthy parties. Picture a group of generals surrounding a city, needing to decide whether to attack or retreat. They can only communicate through messengers, who might be captured or traitors themselves, spreading confusion. This dilemma mirrors blockchain networks, where nodes must agree on transactions despite potential malicious actors. Solutions like proof of work make it costly for attackers to disrupt consensus, while proof of stake penalizes dishonest validators. Understanding this problem is crucial for building secure decentralized systems in our digital age. In the blockchain world, a fork happens when network rules change, leading to two main types: hard forks and soft forks. A hard fork is a significant change that isn't backward compatible. If your node doesn't update, it gets left behind, potentially creating a split into two separate blockchains, like Bitcoin and Bitcoin Cash. On the other hand, a soft fork is compatible with old rules, allowing non-updated nodes to stay connected as long as they follow the basics. Soft forks are typically for minor improvements, keeping the network intact while evolving. Understanding these forks is crucial, as they can significantly impact the future and value of cryptocurrencies. Blockchain technology offers a fascinating array of consensus mechanisms beyond just proof of work and proof of stake. Take delegated proof of stake, for instance, where coin owners elect a handful of delegates to validate transactions, enhancing efficiency. Then there's proof of authority, ideal for private networks, relying on known validators for trust. Practical Byzantine fault tolerance ensures consensus even if some nodes fail, while proof of elapsed time introduces randomness for security. Proof of burn requires users to sacrifice coins, showcasing commitment, and proof of importance rewards active participants. Lastly, proof of history used by Solana streamlines transaction timekeeping alongside POS. Each method has its strengths and weaknesses, tailored to the specific goals of the blockchain. Decentralization means no single party controls the entire system. In cryptocurrency, decisions and validations happen collectively, making it fair and transparent, like the early internet, run by thousands of computers. This third-party-less approach eliminates the need to trust banks. Blockchains operate on consensus, ensuring no one can block transactions or freeze accounts. Plus, with data stored across many nodes worldwide, if one goes down, the network keeps running. This decentralized and distributed nature makes cryptocurrencies like Bitcoin and Ethereum resilient, secure, and transparent. Without it, crypto would just be another easy-to-manipulate database. Transparency in blockchain isn't a vulnerability. It's the backbone of security. Every transaction is visible, but your identity stays hidden behind a wallet address. This openness allows everyone to spot manipulation, like double spending, instantly. Plus, once a transaction is locked in a block, it's immutable. Change one block, and the whole chain breaks. But since every node has the original data, any suspicious alterations are quickly caught and rejected. Decentralization means no single entity can control the network, making it tougher to hack. Sure, there are risks in areas like DeFi, but that's just part of evolving technology. With better smart contracts and privacy tools, we can tackle these challenges. In the end, it's transparency that builds trust and security in the blockchain world.
Blockchain is the most recognized form of distributed ledger technology, but it's not the only player in the game. Alternatives like directed acyclic graphs, or DAGs, such as IOTA and Nano, allow transactions to verify each other without blocks, making them faster and more efficient. Holochain gives each user their own ledger, focusing on local validation, while Hashgraph uses a gossip about gossip method for rapid consensus. Then there are sidechains and Layer 2 solutions like the Lightning Network, which enhance blockchain performance without altering its core. Even traditional databases like MongoDB can store data, though they lack the security and decentralization of blockchain. These alternatives exist because blockchain has its drawbacks: slow speeds, high costs during peak times, and energy demands. Ultimately, the best choice depends on what you need most: scalability, security, or decentralization. NoSQL databases like Cassandra and MongoDB are game changers compared to traditional relational databases like MySQL. While SQL uses structured tables with fixed schemas, NoSQL embraces flexibility with models like documents and key value pairs. This makes NoSQL perfect for semi-structured or unstructured data, allowing for rapid scaling and lightning-fast read-write operations. However, it's important to note that data consistency can be temporary. Now, when we look at blockchain, it takes things up a notch. Unlike NoSQL, which is managed by a central authority, blockchain is decentralized, using consensus mechanisms to ensure data integrity. Once data is on the blockchain, it's immutable, meaning it can't be altered, creating a transparent audit trail. So, while NoSQL excels in speed and scalability for applications like IoT and big data, blockchain shines in trust and security. They complement each other rather than compete, with NoSQL handling performance and blockchain ensuring data integrity. In the world of crypto, NoSQL databases like MongoDB and Cassandra play a crucial role as off-chain storage solutions. They efficiently handle transaction histories, wallet indexes, and blockchain data caches, allowing services like Etherscan and the Graph to deliver fast search results without the delays of direct network processing. Blockchain infrastructure, including nodes and enterprise platforms, leverage NoSQL for large-scale logging and smart contract state management. For instance, Hyperledger Fabric integrates with CouchDB to streamline application data storage. Even Layer 2 technologies like Polygon and Optimism use NoSQL to enhance dashboards and explorers, ensuring quick data processing before syncing with the main blockchain. So, while NoSQL isn't a replacement for blockchain, it significantly boosts data access speed while maintaining the core principles of security and decentralization.
Crypto transaction speed is crucial. We measure it in transactions per second, or TPS, and confirmation time. The faster a network processes transactions, the better. Factors like consensus mechanisms and data structures play a big role. For instance, Solana can handle over 65,000 TPS with confirmation times under a second, thanks to its unique proof of history. Hedera Hashgraph hits 10,000 TPS with lightning-fast confirmations, while Avalanche processes thousands with sub-second finality. Ripple is agile at around 1,500 TPS in just a few seconds, and Nano is almost instant with its unique chain for each account. Even Polygon boosts Ethereum's speed significantly. In contrast, Bitcoin lags at about 7 TPS, prioritizing security and decentralization. Ethereum is evolving, aiming for 100,000 TPS in the future, but speed often comes with trade-offs in security and decentralization.
Transaction fees in cryptocurrency can be a wild ride, varying from nearly zero to sky high. Why? It all boils down to how each network operates. Take Bitcoin, for instance. Its proof-of-work system requires heavy computational power from miners, making fees spike, especially during busy times. On the flip side, Ethereum after the merge, along with coins like Cardano and Solana, uses proof-of-stake, which is way more efficient, keeping fees lower and more stable. Then there are cryptos like IOTA and Nano that use unique tech like DAG, allowing users to verify transactions without miners, resulting in almost no fees. Plus, Layer 2 solutions like Polygon and the Lightning Network help ease congestion and cut costs. And remember, executing smart contracts can be pricier than just sending tokens. So the fee you pay isn't just a number. It reflects the entire design and usage of the network.
The blockchain trilemma is a critical challenge in blockchain development, coined by Vitalik Buterin. It highlights the struggle to balance decentralization, security, and scalability. Take Bitcoin, for instance. It's secure and decentralized, but it struggles with scalability. Conversely, some blockchains sacrifice decentralization for faster transactions. To tackle this, developers explore Layer 1 and Layer 2 solutions like sharding and rollups. Yet, a perfect solution remains elusive. The future of blockchain will likely require a blend of these strategies, aiming for a robust ecosystem that is scalable, secure, and decentralized, paving the way for mass adoption.